What do they typically do? They buy a ton of life insurance, which is really expensive. They try to gift it away to kids, but they can't gift enough away every year because there's only a certain amount. Or they give it all away to charity. Nothing wrong with that, but a lot of people don't want to give all the way to charity. You know, the charitable leadership might change. And so this is where we come in with the DST Plus. In one day, in one transaction, does take a sale. We could sell that $100 million portfolio, move it outside the taxable estate, which eliminates all of that from the 40% death tax.
Now, for people that are going, okay, so when do I pay taxes? Or do I never pay taxes? Or if I die, who pays taxes? What does that look like?
Yeah, so one advantage that 1031 does have over the deferred sales trust is what's called a stepped up basis, which is really important to understand that if you can continue the tax deferral and you die as it stands today, your children can inherit at a stepped up basis, which means essentially they could have no capital gains tax if they sell it after you die. The deferred sales trust, we don't have a stepped up basis because you can't step up on a promissory note, although you can continue to pass the deferral to your kids. So your kids can step in your shoes and they can continue the tax deferral and they can continue that and pass it on to generations. And so
they just got to keep playing the game, right?
Yeah. And so essentially this is the game. You sell it for 10 million, it's owed to $800,000 a year. You live off the interest or partial interest payments, but you never dip into the principal. So you keep the goose laying the golden egg, and that's the payments that are coming off. So that can go on. The last thing I'll leave with this part is though estate tax. Okay. This is really important for everyone listening, right? Because estate tax gets overlooked on the stepped up basis. We think that, oh, we get a stepped up basis, no tax. That's not true. No capital gains tax. However, estate tax is 40% known as the death tax, the government's biggest mousetrap, and that they look at the total amount of your net worth at the time of your death and your spouse's death, and they assess whether or not it's below or above the limits. The limits are right now 26 million married, but they're going to be probably around 12 million married as of 2026, about 6 million single. And they say anything above those amounts will be subject to a 40% death tax. So you've got to get it outside of your taxable estate. So you can either have one, a stepped up basis, or B, outside of your taxable estate, but you can't have both. And so back to the chess analogy, right? You may pay checkers for that first 12 million. Okay, first 12 million of your net worth if you're married, but you need to be playing chess with anything above that to get it outside the taxable estate. So someone owns a $50 million, $100 million portfolio of apartments, right? And they're just counting on the stepped up basis. But what do they typically do? They buy a ton of life insurance, which is really expensive. They try to gift it away to kids, but they can't gift enough away every year because there's only a certain amount. Or they give it all away to charity. Nothing wrong with that, but a lot of people don't want to give all the way to charity. You know, the charitable leadership might change. And so this is where we come in with the DST Plus. In one day, in one transaction, does take a sale. We could sell that $100 million portfolio, move it outside the taxable estate, which eliminates all of that from the 40% death tax. And it's essentially, if you watch Yellowstone, Kevin Costner, this is the entire premise of the show. He's got $100 or $200 million worth of land in the middle of Montana, and he's the last person there. His wife has already died, and Beth, his daughter, is telling Dad, we need to sell it, or if they kill you, they're going to take it anyways because of the death tax. And so every time I watch that show, I'm like, Kevin, use the DST Plus. We got to get it outside taxable estate, baby. And the beauty of that is he could sell it tomorrow, right? He can move it outside his taxable estate. And guess what he could do? He could turn around and go buy the plot of land. You know, I know it's not going to be perfect. Go buy a $200 million, $100 million plot of land over there with the trust and still have all that land and still run all that cattle and do all that stuff. That's cool that he wants to do, but it's all outside the taxable estate. So we could we could wrap up that show, in a half a season if they met us.